to pivot. I'm going to pivot here because you talk about securitization brings me to a topic you and I have long debated privately. Is it better to live on the hedge fund side of the world, or is it better to live in the 40 Act, the mutual fund and ETF side of the world? And I, as someone who lives in the mutual fund 1940 Act side with ETFs and mutual funds, I always say, damn, hedge funds seem pretty sweet. And you, as someone who lives in the hedge fund side, look over at my side of the fence and you say, man, those ETFs, those look tasty. And I go, you have no idea what you're talking about, my man. This is a horrible business. You're the one with the great business. And then you tell me all the shit you go through. And I think we both agree that in many ways it sucks all around. But grass is always greener, except I think you walked away from this week finally maybe with your held head up high going, you want to know what ETFs do suck more than what I do. I want you to talk about that.
First of all, yeah, grass is greener. It does beg the question though, Corey. But
never begs the question.
It's perfect of why you can't share this. Shout out to Dennis Dadvet in the chat wrote, quote, just a boomer spitballing here. God, that has to be code for something. Yeah. Everything. Dennis coming in with the heat on that one.
You're 100% getting demonetized.
Yeah. Well, yeah. By the way, we appreciate our sponsor from Liquid Death that never gets put on here, but love the water. I'm sure it comes from a great Austrian tap. Yeah, just add bubbles and some great artwork. I don't appreciate you taking a victory lap here. I mean, I think you about broke your arm patting yourself on the back on this one because you have been telling me this for a long time.
Hold on. But this is me patting myself on the back despite the fact I've dedicated my life to it. So it's like one of those it's like, good job, Corey, you moron.
Yeah, well, that's usually part of our conversation because, and I'll make it public. So just to embarrass you is like, you're the smartest, most well-respected person across all sectors of our industry. And yet you work in a space where you make negative money. Like I'm always trying to get you over to this dark world of hedge funds so that you can actually make a living, but that's part of it. So you want to debate that?
I make more than negative money. Thank you.
I don't know what I learned about the ETF industry this week. I don't think any of you guys make money. But the other side of it, and this is going to be a sweet chef's kiss for me with Sean Weiland here. A good part of me, if not all of me, is a pure communist socialist, and that's why I love the ETF industry. Is like I want to produce things. I want to bring institutional quality portfolio construction down to non-accredited retail. And that's what always gets me excited about it. And that's what makes me want to jump through the hoops and deal with all the headaches. So it's more about the product creation and bringing something in the market that doesn't exist that excites me. But then, to your point, I start going through all the economics and I'm like, there's no way to make money on this. Like the only way you start to make money is if you get into the billions. And I would argue almost like getting closer to double-digit billions. And then those tiny little bits you're carving off finally add up to something after you pay all the regulators, you pay off the vendors and everything. And that's what I was saying, like from a startup perspective, you would have to raise so much money to make this work, to give yourself enough runway for a few years. And I hate like having to raise money. I'd prefer bootstrapping. And then eventually maybe you get lucky and you get to a few $100 million. Well, you're running probably, negative or deficit financing. So you got to get to a few billion. Oh, now you're at break even. And then you have to get to tens of billions. And it's like to shoot the lights out, like to do that, like the impossibility of that, the probabilities of you getting to like billions of dollars in AUM on your ETF. I mean, everybody of course thinks they can, but like that's the only point it starts to get profitable. And then everybody comes to you and go, yeah, but Vanguard charges 3 bips and you're charging me like 39 bips. And like, so there's just no winning there. And there's a lot of just Me Too products in the industry. So then it comes about marketing spend and can I out market these other people because everybody's putting out the same crap? Like it's just a never-ending vicious cycle, and I just got more and more discouraged listening to like all this different aspects of the ETF industry and all the costs associated with it.
Yeah, and I think to continue on that, right? So just to give some context, so you launch an ETF, assume the launch cost is somewhere between $75,000 to $100,000 in legal and startup costs just to get the thing out the door, and then you're probably paying around $200,000 to $250,000 a year. Again, depending on how much scale you have. Is it a shared trust? Are you running your own trust? What are the operations like? How complex is it? Do you have a Cayman sub? What's the auditor situation like? All that stuff, right? But if you're, if you're only charging 10 bips on as a unitary fee on the product, and need to pay 250 grand a year in expenses, like you can figure out the break even pretty easily, and it's pretty damn high, right?
But it's not that. Can you talk about the one thing, I found out those things before, but other things you taught me that I was kind of surprised by is you have like a board of directors and reserves. And is that a regulatory function too? You have to have a certain amount of reserves. So you need to raise capital, even to just sit there and hold in cash and reserves for like somebody's auditing your business and the board of directors. Like, is that across the board?
You talk about, right? So the benefit of going to a 40 Act vehicle, a registered investment company like a mutual fund or an ETF, is that you can get non-accredited investors to invest with you. To make that okay, there are a huge amount of regulations you need to comply with, and there is a board that oversees the registered investment company, who will, as an advisor or a sub-advisor, make you fill out what's called a 15C. And every year, you're basically going to the board, telling them about the business, how the fund did, and they're reviewing your stability as an asset manager. So one of the things they want to make sure is you're on the hook for the expenses. Do you have enough capital on your balance sheet? What's your revenue like? Are you running out of money that's going to cause this company to go belly up, that you can't afford the expenses? That's something they keep their eye on. How much runway do you really have with this product? So yeah, I mean, in many ways, you got to keep a bunch of cash on the balance sheet if you're not at break even, to prove to them you got a multi-year runway to get to break even. Once you're at break even and it's growing, right, they don't need to see that balance sheet as much. But if you're launching a new product, you need a healthy balance sheet for sure. And I would argue you probably need several years of runway. So, you either need to prove you have the revenue to offset the losses, or you need, right, $500,000 to $1 million just sitting on your balance sheet.
Let me interrupt you for a second here, because this is one of the ones that's actually come up a lot for me this week, when people call both you and I up a lot of times to run their business plan by us, or their marketing plan, or to get help with their marketing plan or their pitch decks or whatever it is. And the whole idea of like, if you build it, they will come, or like, I'm a great trader, I have a great track record, so automatically money's going to flow into me, and they don't have a marketing plan. We're like, that is never ever going to work, and it's dramatically underestimating. It's like the smallest part of our business is actually like the trading or the portfolio construction. The biggest part of our business is like, can you run an actual business? Most people don't have the chops to actually run the business of running an investment business is much harder than the trading side of it. And then more importantly, like, what is your actual marketing plan? Because it's almost like, I think of two analogies is like when authors think, oh, I'll just sign with a publisher and they'll take care of everything. No, they don't do any marketing for you. The marketing plan is still on you. Similarly, like the stereotypical one is people are like, oh, I'm a great home cook, I'll start a restaurant. It's like, that's not how life works. Like, you need to be able to run a business. You need to have a marketing plan. And so so you're talking about the years down the road. I had a firm, mutual friends came to me this week, and they were kind of talking about like, well, kind of what their roadmap and runway was. And I was like, 4 years minimum. And that's luck. And I'm like, they're like, what? I'm like, in especially in the hedge fund space, if you want institutional allocations, you're going to need a minimum of a 2-year track record, a minimum of probably 100 million assets under management. And then the institutions will start looking at you, and they have a 1.5 to 2 year sales cycles. So in a best case scenario, you're talking 4 years before you start making any money or getting any sizable allocations. Sorry for that interlude, but like, that kind of stuff drives me nuts. It's like, everybody just thinks you launch it and you're just Scrooge McDuck, diving into your coins.
I think you hit the nail on the head. The way I always think about it is investment management is different than asset management. Your asset management company has an investment management component. Like, you need, like, that is table stakes though. Then you need to figure out the marketing and the sales and the distribution and platform access. To the point about hedge funds versus mutual funds and ETFs, like, when you launch an ETF, it's available at Fidelity, Schwab, TD, Pershing. It's not available at UBS, Morgan Stanley, Goldman Sachs. It's not available at LPL or Raymond James or the big independent broker dealers. You have to get it up to a certain size, and then you have to go interact with the gatekeepers, and then you have to start stroking checks, and then you have to go through the due diligence process. Like, that's a key accounts is a huge part of managing that, so that people can get access.
And I'll say the thing you won't say. I will say the thing we won't say on those platforms too. To me, they charge extortion. They call it like data fees and everything, but you have to pay to get on these platforms. It's pay to play. And then on the platforms, like you said, I was just talking to some people lately. It's got even worse, where they want 50 to 100 million day one on their platform. Do you know how hard that it? Like that's impossible. Like if you're trying to get on 5 or 6 platforms and you're supposed to put it on their platform day one, like they're just making it harder and harder.
Yeah. The other side too that I think is interesting is when you run a hedge fund, the returns are only as public kind as you want them to be, right? When you run a 40 Act vehicle, they are public every day. When you run an ETF, right, you're not striking NAV, like you are striking NAV, but what most people are looking at is price. And so what happens is very early days, market makers are only quoting so much. So think about it this way. Market makers are a hugely important part of the ETF ecosystem. Most of the time when you buy and sell on the exchange, you're buying and selling from the market maker. Especially in a new ETF, almost predominantly you're buying and selling from the market maker. But if there's only like, say, $500,000 of volume every day, the market maker is not going to create $10 million of depth in the book, right? That's a waste of their assets. There's a cost of capital for them. So they're only going to put maybe 250,000, 100,000 up at a time. And then as volume comes in, they'll recycle money throughout the day. So if you're not a super sophisticated investor and you're not thinking and you go, wow, this ETF looks great, I'm going to buy $10 million worth, and you throw a market order in when the book depth is $100,000, it doesn't matter how liquid the underlying are. You're all of a sudden going to print 7% above NAV. So you launch a new ETF. It should be super liquid. Someone goes and does a really dumb trade, and now all of a sudden, permanently in your performance, you've got this super hairy candle, right? Someone got a really bad fill, and then people start to ask you, well, it looks like your ETF is illiquid. Like, how come it's not? Now I'm concerned about buying and selling and exiting for my clients, when in reality, if someone did it intelligently, it wouldn't be an issue. But if someone does it in a way that they're just not thoughtful about it, yeah, you can get your face ripped off in a less liquid ETF. So, and none of that applies. It doesn't apply to the mutual fund side, doesn't apply to the hedge fund side very easily. Like, it's just there are all these other issues that pop up in the ETF that just make it a difficult vehicle to be successful with as a boutique.
Several things on that. One, thankfully it stopped again, but it wouldn't be a Pirates episode if your microphone wasn't popcorning in a little bit. But like it's kind of going in and out. So don't unplug it yet because I don't want to even mess it up. 2, this is so perfect. Booty Cruise. Sean said in the comments, I thought I deleted stroking checks from my browser history. But then I want to shout out for Murph in here. Appreciate this comment. This is so true. Like our industry, this is a great example. Was at a $1 billion boutique manager with big seed, and it took 4 years to get to client number 2. At first needed a 3-year track record. Then no one wanted to be the second client. Like you've drawn this great diagram for me many times. It's like, oh, I'm too late. I don't want to invest. I missed it. Or I'm too early. I don't want to invest. It's I'm going to wait to see when it's too late. Then get that investment. And so that's what people don't realize how often that happens. Then the worst thing in my side of the world is institutional allocators come in and go, well, our minimum check size is $100 million, but we can't be more than like 5% of your fund. And you're like,
I don't get that. I don't understand that at all. I just had this argument. Look, there are reasons that, like, if you're a fund trying to buy another fund, if you're a mutual fund trying to buy an ETF, there is a certain limitation. If you go over 3 or 5%, you need to start filing and let people know. There are concerns about regulatory ownership. But if you're like an advisor or an institution allocating capital, I don't understand why you give a shit. The only good excuse I heard, and I actually heard this from someone this week when I was talking to them, said, look, I don't want to be a big part of your fund because I don't want to hold your career risk in my hands. Like if I just had to exit the fund for some reason, I don't want to remove 90% of the assets. I can appreciate that. That is just a personal relationship thing. But when people try to make excuses of like, oh, it's prudent for the investors or it's a liquidity issue or whatever, it's like, everything I'm trading is hyper liquid. Like you could go to the market makers right now and get a quote, 2-way quote for $100 million. And I guarantee it would be tight. Right. So like this whole bullshit about I can only be 5%. To me, it's a big optics thing, but like they make it seem like it's an operational thing.
Right. And like you said, I would agree with him as like illiquid PE investments or something like that. Then I agree. But like when we're trading highly liquid stuff that's like has, like can be liquid in seconds. It doesn't make any sense at all. It's like when you go to get your first job. It's like we only have people with experience, and you're like, how do I get experience if you won't give me a job?
Right,
by the way, I don't want to blow up your spot, but I forgot to tell you, behind your back, some people are telling me you got some great market makers on stuff you're doing that we can't talk about. That like they were impressed with how they're making your market. So, but like you were saying, you have to create those relationships. And if I could sum up everything I've learned about ETFs, is like the multiple levels of reach arounds you have to give to run an ETF is just anathema to me as an entrepreneur. And I can't stand these other people controlling my destiny like that.